Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Inspire Veterinary Partners.
If you find our talks useful, please consider subscribe, like, and comment underneath to support us. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis. This is a really fascinating one, a high-stakes story.
It seems like a real puzzle.
It is. With Inspire Veterinary Partners, you have a company that's showing, well, surprisingly strong operational numbers. But at the same time, it's facing this huge financial and regulatory cliff edge.
Right. And our job today is to kind of unpack that contradiction for you. How can a business be growing so well, yet the stock is trading like it's in deep, deep trouble?
Exactly. So let's start with the basics. The foundation, Inspire Veterinary Partners, is in the pet care space.
Which has a massive tailwinds, structurally.
Huge. And their strategy is a classic roll-up model. They're a consolidation platform in the U.S. veterinary hospital market.
Okay, so for anyone who isn't familiar, what exactly is a roll-up? Why does that model work so well here in veterinary medicine?
It works because the market is just incredibly fragmented. It's still dominated by these independent single-location clinics.
Usually run by the vet who started it?
Precisely. And those small clinics, they just lack economies of scale. They're paying retail for supplies. They don't have big marketing departments, no sophisticated IT.
So Inspire comes in, buys the clinic, and plugs it into this larger system that immediately makes it more efficient.
That's the idea. They currently have 14 hospitals across 9 states. They centralize all the back office stuff, procurement, finance, HR. It frees up the vets to just be vets.
And it looks like they're being strategic about it too, not just small animal practices.
They're expanding into mixed animal facilities and critical and emergency care, higher value services.
Okay, so the strategy is sound, the industry is great, but with any roll-up, execution is everything.
It is everything. You can't just buy growth. And this is where their third quarter financials for 2025 become genuinely compelling.
This is where the story gets interesting.
It really is. The numbers show that management is actually, effectively integrating these clinics. Overall revenue was up 7% year over year.
Which is good, solid growth. But that number can be misleading.
It can, because it includes newly acquired clinics. The really crucial metric, the one that shows you the health of the existing business, is the same store momentum.
Right. You have to compare apples to apples.
And their comparable clinic revenues,
Yes.
so only the locations they've owned for at least a year, grew an impressive 9.2% year over year in Q3.
Wow. Okay, 9.2%. That's fantastic for a service business.
It's fantastic. It tells you 2 things. 1, demand is really strong. And 2, the systems they're putting in place are making the existing hospitals more productive.
So hang on. The total revenue is up 7%, but same-store sales are up over 9%. That kind of suggests the new clinics they're buying are actually getting a performance boost once they join the system?
That's a very sharp observation. And it absolutely supports the idea that their model is working. It's not just growth by acquisition, it's growth by improvement.
And they're tackling costs, too, I saw.
Surgically. They cut their general and administrative expenses by 19% year over year in 1 quarter.
19%. How do you even do that without breaking things in the back office?
It's that centralization we talked about. Consolidating contracts, a single IT platform, leaning out the corporate overhead. That kind of cut flows directly to the bottom line.
So better sales, tight cost control. What did that do for profitability?
Well, the net effect was that their net losses narrowed by a massive 27% year over year. Still a loss, mind you, about $2.5 million.
But a 27% reduction in the burn rate is serious momentum. That's a ship turning around.
It really is. You could even see it stabilizing before this. The loss in 2024 was $14.2 million versus $14.7 million in 2023. So they stopped the bleeding, and now they started the healing process.
Okay, so the business itself is strong, getting stronger, but none of that explains why the stock is priced for disaster. Which brings us to the elephant in the room.
The huge flashing red light. The acute regulatory and financial overhang. This completely overshadows all those good fundamentals.
And it all centers on their NASDAQ listing status.
Yes. And to be fair, they had a win recently. Back in August 2025, they regained compliance on the stockholders' equity requirement.
How'd they do that?
They raised $5 million in a preferred stock placement. It was a major win.
But that victory didn't last long, did it?
About 3 months. In November 2025, boom, a new formal delisting notice from NASDAQ.
And this time it was about the stock price, the minimum bid.
Correct. Falling below the $1
Now,
minimum.
companies fall below a dollar all the time. They usually get a grace period, right? 6 months to sort it out. Why is this different? Why is this a crisis?
This is the absolute sticking point. Because of their history of doing reverse stock splits, a lot of them, at a ratio of at least 250 to 1.
Oh,
They're not eligible for that automatic grace period.
okay, let's break that down for everyone. A reverse stock split is when a company just reduces the number of shares to artificially pump up the price of each one.
Yeah, it's a financial engineering, yes.
Yeah.
But NASDAQ has what's basically a bad actor rule. If you have to keep resorting to these massive reverse splits, they see it as a kind of chronic failure. They say, you've tried this trick too many times, and they revoke the grace period.
And that puts them on a very, very tight deadline.
An incredibly tight one. They had to appeal to NASDAQ by November 20th. If they lose that appeal, trading gets suspended, and the stock gets delisted to the OTC market on November 24th.
Just days from now. And moving to the OTC market, what does that practically mean for an investor?
It's a huge blow. A lot of big institutions are legally forbidden from holding OTC stocks. Analyst coverage disappears. Trading volume dries up. Liquidity vanishes.
So the fate of the stock, at least for the next month, has almost nothing to do with their 9.2% same-store sales growth.
Nothing at all. It's a binary outcome based on this one regulatory decision.
That is the cliff.
Right.
Okay, so let's imagine for a second they pull it off, they win the appeal, they find a way to stay listed. If they survive that threat, what's the growth engine? What are the catalysts that make this risk worth it?
The big one is leveraging their existing network to create a new, higher margin revenue stream. And that is their planned launch of an integrated online pet pharmacy.
An online pharmacy. That sounds like a move to build a real competitive moat, something beyond just buying more clinics.
It absolutely is. They're aiming for a Q1 2026 launch. And this isn't just, another website selling pet meds. It's integrated.
What does that mean, integrated?
It means it uses their physical clinics to validate prescriptions and fulfill orders for the clients who are already in their system.
Ah, so instead of your vet giving you a prescription and you going to Chewy or somewhere else to fill it,
You stay within the Inspire ecosystem. You keep that high-margin sale in-house. It should dramatically increase customer stickiness.
it makes sense. If your vet records, appointments, and prescriptions are all in one app, you're much less likely to leave.
Exactly. And we're already seeing their product revenues jump up 9% in Q3, even before this platform exists. This new pharmacy is designed to pour fuel on that fire.
That's the operational upside. But with the stock trading around, 12 cents? Is there any sign that smart money actually believes in this kind of recovery?
There's one remarkable signal. You have to look back to March of 2025. An institutional investor took part in a capital raise, and they accepted warrants.
Warrant, so the right to buy the stock at a set price in the future.
Right, and you have to hear this price.
What was it?
The exercise price on those warrants is $1.83 per share. And they don't expire until the year 2030.
Wait, I want to make sure everyone heard that. The stock is at 12 cents,
Yeah.
and a professional investor is holding the right to buy it years from now at $1.83.
A roughly 15-fold upside from where it's trading now.
I mean, why would anyone accept a deal like that unless they thought the current price was just totally disconnected from the real long-term value of the business?
It's the clearest signal of long-term conviction you could ask for. It suggests they believe this is a temporary regulatory problem and that the underlying business is worth exponentially more.
That really does speak volumes. Okay, so setting the NASDAQ crisis aside for a moment, if they navigate that, what are the biggest non-regulatory risks?
I see two main ones. First is the persistent cash burn. We celebrated the 27% reduction in net loss, but it's still a loss.
So they're still burning through cash every quarter.
Exactly. They're still reliant on outside funding. We saw they just took on about $357,000 in convertible notes for working capital. That tells you they're living month to month.
So they're in a race. They have to get to cash flow positive before the financing options dry up.
It's a race against the clock on two fronts, NASDAQ and their own cash reserves. And the second risk is just pure execution risk.
On the M&A and the pharmacy?
Yes, integrating hospitals is hard. Maintaining that 9.2% same-store growth is hard. And then launching a brand new online pharmacy in Q1 2026.
Against established giants in the space.
Right. They have to compete with the big dogs immediately. Management has proven they can cut costs. Building and scaling a successful digital platform is a whole different skill set.
Okay, so let's try to wrap this all up for you. Inspire Veterinary Partners is, it's a classic micro-cap story. It's priced for failure, and that's made worse by this immediate regulatory crisis.
But underneath all that noise, The core business is showing some incredibly strong vital signs. That 7% revenue growth, the stellar 9.2% same-clinic growth, and a 27% reduction in net loss.
So that duality is the whole investment case.
It is. The short term, the next few weeks, is a coin flip on the NASDAQ appeal. But the long term, say over the next 1 to 2 years,
That's where the real potential is.
it's a high-reward turnaround play. It's a bet on continued operational excellence and a successful launch of that online pharmacy. If they pull it off, that $1.83 warrant price shows you just how big the recovery could be.
What's so fascinating here is how the strength of the underlying business, that 9.2% same clinic growth, which is genuinely fantastic, is being completely overshadowed by these critical regulatory and financing risks. It raises an important question. Can management execute a successful operational turnaround fast enough to outrun the clock on their listing requirement?
That's something for you to mull over. Thank you for joining us for this analysis of Inspire Veterinary Partners. If you want to stay on top of these high-space market moments, please remember to subscribe, like, and comment to support us.
We'll be back tomorrow with another exploration of the markets.